Hey guys, Kylie here and welcome to the channel. So ETFs have become super popular over the last 10 years because they allow you to invest in a diversified portfolio of stocks. And even though the returns aren't as big as, say, if you were investing in individual stocks, they're considered to be a lot safer. Well, what if I told you you could get a 500% return on an ETF in just 1 year? You'd say no, that's not possible. Well, it is. And today I'm going to take you through the top 10 best performing ETFs over the past 12 months. I'll talk about what they're invested in, why they went up, and what we can learn from it. Just a quick point, ETFs kind of have different classifications around the world. So structured ETFs are sometimes called ETPs, exchange traded products. For the sake of this video, I'm just going to be looking at listed investment funds, regardless of the strategy, so active funds and passive funds. Okay, let's get into the ETFs. So coming in at number 10, we have the ProShares Ultra Oil and Gas ETF, DIG. This ETF has risen 300% in the past 12 months, which is pretty big for an ETF. And we're only at number 10. This ETF tracks the Dow Jones Oil and Gas Index, which is made up of stocks like Exxon and Chevron. This is also a 2 times leveraged ETF, so essentially it's using complex financial instruments, derivatives, to magnify the gains. You can also get an ETF that does the inverse and short the market, so if the market goes down, then the price of the index would go up. This ETF has gone up because of booming global demand in oil. Global markets have seen an incredible rebound in the demand for energy since COVID-19. At one point in April 2020, oil futures crashed to around minus $40 a barrel. They are now back to over $80 a barrel. And the global energy crisis is getting worse across China and Europe, which could be a bullish sign for this ETF over the coming months. In ninth position with a gain of 310% is the Diversification Daily Retail Bull ETF. This is a 3 times leveraged fund that tracks the S&P Retail Select Industry Index. Interestingly, this index is made up of car dealers and automotive retailers such as Group 1 Automotive and AutoNation. The growth in this index has been underpinned by the surging demand for cars during the pandemic period, which has been brought about by shortages in parts as well as distribution bottlenecks. Next up is another Diversification fund. It's the Diversification Daily Regional Banks Bull 3 times Shares ETF. These have really long names. Why do ETFs all have super long names? So the Diversification Regional Banks Bull Fund is up around 320% in the past 12 months. It tracks the S&P Regional Banks Select Industry Index, which is made up of a collection of 132 regional banks across the United States. So a lot of these stocks have seen really big gains since the COVID-19 market crash. And, multiply those by the leverage in this fund and you get some pretty impressive gains. Banking firms have done really well over the last 12 months because they crashed during the COVID-19 market crash, and now they're back up again as people want to, buy houses and borrow loans for their business. If the market was to crash again, well, then this ETF wouldn't do so well. So taking out the 7th spot on the list is the Breakwave Dry Bulk Shipping ETF, BDRY. I love these super niche ETFs. Helps you to get really granular with your investing strategy. So after the past 12 months, BDRY is now up about 330% at the time of this recording. Interestingly, this fund gives you exposure to the dry bulk shipping market, which is the market for raw materials that are shipped in unpackaged parcels, like think metal, grain, and commodities. So in the shipping market, futures contracts have been set up to track the prices paid in the transport of goods in various shipping routes around the world. Long story short, when the demand and cost for shipping goes up, then the price of these indices will go up too. And in the past 12 months, the demand for materials like coal has gone up massively. And that's put huge pressures on ship supply. Plus, COVID-related transport disruptions, as well as the rising cost of fuel, have been huge tailwinds for this ETF. In 6th spot on the ladder is yet another Diversification product. It's the Diversification Daily Financial Bull ETF, or FAS. This index has narrowly beat out the dry bulk shipping index over the past 12 months with gains of 331%. This ETF tracks the Russell 1000 Financial Services Index. The Russell 1000 tracks Berkshire Hathaway, JP Morgan, Bank of America, Morgan Stanley, and Goldman Sachs. A lot of stocks in this index have seen gains of over 100% in the past 12 months. And if you multiply that with 3 times leverage, which is what this ETF offers, it totals out at a crazy 330% gain. Next up is the Wisdom Tree Brent Crude Oil 2 times daily leveraged ETF that is listed on the London Stock Exchange, and it is LBRT. It's up 367% over the last 12 months. This ETF is designed to give investors a leveraged exposure to the Brent crude oil futures contracts by tracking the Bloomberg Brent Crude Sub-Index. So it's designed to reflect a 200% return of the daily percentage change in the index level. So if oil prices are doing really well, you'll do doubly well. If oil prices are doing really badly, you'll do really, really badly. Next is the Direxion Daily S&P 500 High Beta Bull Shares ETF. That's HIBL, and it's up 440%. So this ETF tracks the S&P 500 High Beta Index. So in investing, beta refers to the measure of a stock's volatility in relation to the overall market. HIBL measures the performance of 100 companies in the S&P 500 that are most sensitive to changes in the market, so the most volatile stocks. So this fund has risen on the back of huge upside in volatile stocks included in the index, like Tesla and Nvidia, and it magnifies gains as these stocks go up in price by 300%. So here, volatility is in your favor, and you have the potential to see huge gains, but of course big losses also during a downturn. Although they do have an answer to that too, which is called the HIBS Bear Fund, which will deliver exactly the same results, but if the market is crashing. It's what is called an inverse ETF. Probably around March last year, it was doing very, very well. Up next is the Panda Growth Fund, or PTF. PTF trades on Canada's TSX Ventures Exchange. This is an exchange for early stage companies. So the strategy of this fund is to invest in small businesses that it thinks have big potential. Usually these are technology companies based in Canada with fewer than 100 employees. So it sounds like a risky buy-in, but that strategy has obviously paid off very well for investors. So taking out silver medal for the best performing ETF of the last 12 months is the Direxion's Gush ETF, GUSH. It's up close to 490% in the past 12 months. This fund gives you exposure to the S&P Oil and Gas Exploration Index and the Production Select Industry Index. Just a heads up, it's very hot today in Sydney. I'm starting to sweat. So these indices hold like energy, petroleum, and resources companies. Exploration stage companies are typically the smaller mining or gas companies that are searching for a gold mine, or in this case, an oil field. So it's very risky, as they might not find anything at all. But of course, the rewards are very big if they do. And obviously that's paid off in the case of this ETF. Finally, the gold medal goes to the Grayscale Ethereum Trust, with a whopping 510% return. And just a heads up, I know this is not technically an ETF, it's an unlisted trust, but it came up on my screen anyways, and the number is just so great that I thought I'd include it. Plus you can access it through some online brokers, although it has a minimum investment of $25,000 last I checked. And as you might expect, ETH is passively invested in the cryptocurrency Ethereum. And while it's not yet an ETF, Grayscale has filed with the SEC to convert some of their cryptocurrency trust funds into spot ETFs if approved. And while it doesn't yet trade on any exchanges, it does report to the SEC. So that was the top 10 ETFs of 2021. And some of them were pretty niche, so congrats if you'd invested in any of them. What can we learn from this? And what is it about these ETFs that just dominated? Well, as you were watching this video, you probably noticed that there were a number of common themes. First, they tie in with what's been happening with the economy, the impact of global supply shortages, prices across oil, gas, shipping, and even cars have skyrocketed. So ETFs that were laser focused in some of these areas have done incredibly well. Second, the power of leverage. You'll notice that many of these products in the top 10 had 2 times or 3 times leverage. And when you get a product that is 2 times leverage, it means that your returns are double what you'd normally get. But by that same token, any losses are also double. So while you open yourself up to huge gains, you also expose yourself to potentially huge losses too. Thirdly, there's the rise of cryptocurrency. And while I didn't include these in the list, there are a number of exchange-traded products in Europe that directly track the price of different cryptocurrencies. These aren't exactly ETFs though, like you might think. In the UK, these are ETNs or exchange-traded notes. And some of these products have achieved much higher than what we've seen on the list today. But crypto ETFs are only starting to take off. The US, as of 2021, has launched its first official Bitcoin ETF, BITO, and over the coming months, if more ETFs are approved, it's very possible that a range of crypto ETFs in the States and Australia could get these super high returns, especially if they use leverage. Of course, by that same token, if crypto markets fall, then you can expect to see some very big losses too. Alright, that's it from me. Thanks for supporting the channel. As always, feel free to leave a comment in the section below. Have you invested in any of these ETFs, and would you? Why or why not? I'd love to hear from you. Thanks a lot. See you next time.